Happy Monday, everybody, or not so happy Monday. We see the markets here, the Dow Jones Industrial Average down 1.8%. Just want to quickly review what's going on overseas because we've got a bit of a correction going on here. Hang Seng Shanghai down 2.8, 1.6%. They're down 15%, folks, from their recent highs. So this is not recently. We hit their highs way back in April here. Nikkei, Italy, Germany, all down. The whole world's down 1 to 2.5%. Here in the United States, obviously, semiconductors extremely exposed to China. There's your weakness right there. There's your MCHI. That's the China ETF, the main China ETF here. Energy's getting clobbered again as oil is down. Even domestic energy companies down. Gold miners are doing well. Gold and gold miners are doing up. Utilities are flattish. Consumer staples slightly down. Utilities, more defensive stocks, generally doing a little bit better. The big question now is this like May? Is August going to be like the month of May that led to the month of June when things turned around? So let's review what happened in May. The trade talks broke down. Sound familiar? The U.S. hiked China tariffs from 10% to 25%. China retaliated with putting tariffs of its own on. We had the Huawei ban. We had some conflict with Mexico as well. A whole lot of nasty stuff happened. And what was the effect of all of this? More tariffs? Well, the markets were notably weak. S&P was down 6% in May. Crude was down 16%. The 10-year yield dropped to 2.1. What was that? Sound nostalgic for that? That was the lowest since 2017. Does this sound familiar? This is all a pattern that we saw back in May. And then remember what happened in early June. People started to believe that somehow some kind of deal or truce was going to be made at the G20 meeting. And indeed, markets rose in June, and that's what happened on June 28th. Essentially, there was a truce. And now that truce has kind of gone away. And now the question is, what happens from here? We don't have a G20 meeting coming up. And China letting its currency move like it did today, that's a sign they may be steeling themselves for a longer conflict. So the question is, what can you go into? What's safe for the markets for people to buy right now? Just take a look at some of this stuff. Remember what happened? Telecom stocks. This was a relatively safe play back in May. These stocks, your AT&Ts, your American Tower, they held up reasonably well. All right, maybe that's a safe area to go in. How about healthcare? That was another sector. If you look what happened in May, like the hospital stocks, for example, put that up there. You see some of these hospital names, Tenet, HCA, even Centene, United Health, slightly different space in healthcare. These held up reasonably well in May. But beyond that, beyond some utility stocks, it gets very, very difficult. So some people are arguing, how about domestic energy stocks? How about some Valero and the refiners? They got clobbered in May. All of the big exploration production companies, your Hess, your Pioneer, all domestic oriented. The global markets dropped, demand for oil dropped. These companies all went down. This is probably not a safe area to say, oh, just because they're domestic, let's buy them. Didn't work in May, that's for sure. How about some other things? Well, there was arguments out there. Let's go buy home builders. So the home builders dropped in May, not quite as much as the whole S&P, but it was down about 5%. How about aerospace and defense? Turned out that dropped too. They sold the overall market, and a lot of people said, well, let's buy some select areas of the overall technology area, like cybersecurity, for example. Many of these companies have most of their revenues in the United States, and they dropped as well. So what's the point of all this? There are some areas of safety, some healthcare, some telecom, some utilities, but overall, the market is expensive right now. Even consumer staples that are considered to be defensive are very expensive. So there's not a lot of places to hide when the market is this pricey. Not a lot of stuff that's dramatically down 10% and still has complete domestic exposure. I think that's what the market is telling us right now, that the choices for investors, other than just hold back, rotate, is a tougher game to play when the market is this expensive.